Joining us now, Tim Adams, Institute of International Finance President and CEO. The IIF represents 400 banks and financial institutions around the world. Tim, good to see you. So you say you don't believe the market tumult of the last few months should be called a banking crisis. I just wonder, if rates in the U.S. do stay higher for longer, can we feel confident about what the impact of that is going to be? Are we going to get healthy consolidation with the smaller banks?
John, thanks for having me here today. Yeah, look, if you look at the financial conditions indices, we're back where we were pre-March. You know, the market's digested of the four institutions that had trouble in February, March. And as we've seen, the large institutions from earnings last week, and I think we'll see this week, are fundamentally sound and doing quite well. I think we will see consolidation in the industry going forward. It probably won't happen very quickly because there's a lot of mixed messages out of Washington. But I think consolidation is a healthy trend for the industry writ large.
So, but these capital requirements for the banks, you don't think are healthy. Why not? And what would be healthy, particularly for the smaller banks, to make sure that we do end up with the kind of healthy environment that we were just talking about if consolidation happens?
You know, the most healthy environment is the profitable institutions, and one in which the macro environment is performing well. And we want to see fast growth. We want to see capital formation, job creation, and rising living standards. And we want to be a part of that solution. You know, rising capital and more regulations is detrimental to that trajectory. It's about a growth story. And if the economy is growing, the banks are doing well, and vice versa. What
about China? Right now, the growth in China slow. There's a lot of unemployed young people, which is not good for any economy, but certainly not one where things don't seem to be speeding up. What kind of impact is that going to have on economies and financial institutions around the world?
Yeah, John, you're absolutely right. It's been a bit surprising and troubling, the data out of China, much weaker than we expected. We're actually marking down our forecast for this year. The traditional drivers of growth out of China: exports, capital formation, and real estate's really underperforming. They seem to not have the policy levers they've had in the past. Secretary Yellen mentioned today in the G20 meeting that there will be spillover effects globally. Indeed, there will be. So I think we need to prepare for a negative shock from China, and hopefully they can find a policy paradigm going forward that brings about a little bit faster growth than what we're seeing in the second quarter.
But at the same time, is that uncertainty in China's economy, or that slowing, bringing a nicer, less hawkish China? It sure seems like there's some de-escalation, some cooling, at least in the language, U.S.-China relations, and you feel like those tensions have been a big risk.
They have been a risk. They remain a risk going forward. I don't think that's going to change much over time. Although, again, I'll give an applause to Secretary Yellen. I thought she did an excellent job in Beijing trying to cool those tensions. But there's some fundamental challenges that exist between the U.S. and China. It's going to take some time to work through it. It's going to take leadership on both sides of the Pacific. So a lot of work to do, but kudos to Secretary Yellen for the work that she's done over the past month.
How big an X factor is debt, both in China, where we haven't been used to talking that much about the impact of debt, but it's risen precipitously lately, and then, of course, in the U.S.?
Yeah, globally, we're at $300 trillion worth of debt, 350% of GDP. And whether sovereign, household, or corporate, or sub-sovereign, we've seen a massive increase. And in the U.S., I worry about the U.S. fiscal trajectory. We've added $10 trillion to our debt over the past 7 years. It's not sustainable, John, and we're going to have to find a policy process going forward that reins in that debt, not only in the U.S., but globally.
So what sorts of policy processes are you expecting, and what's the likely impact on financials?
Yeah, in the U.S., I'm not expecting much of anything in the near term. We're running a huge fiscal deficit relative to GDP. That's going to continue. The administration wants to spend on infrastructure. I'm for that. But there's really not a serious conversation in Washington about fiscal sobriety. It will happen someday when the markets stop taking in treasuries. But in the meantime, Washington has decided that there's not a problem.